So, Stephen, we've had the best two-day rally since at least January, right? Is there room for more?
Oh, there's plenty more. You're too kind, by the way. It looks like a triple top on the chart. Not that we hold much by charts. A client told me, actually, there was a previous peak, so that makes it four tops. Maybe we should call it the four tops. So the market seems to want to hold around the 5% level for the twos in the treasuries, and 10's a bit lower. So, and there's something quite strong and fundamental underneath this. The Fed doesn't want to hike, and they've just confirmed that. So it's very unlikely rates are going to go up. And if you know the next move is down, you have an asymmetric setup. You might as well just be long and wait. Just be patient. They're going to cut. The question is it July or is it later in the year? And once they start cutting, they'll keep going, and bonds are going to do well. So that's part of the setup here.
So if you missed the last couple of peaks, or three, perhaps, if there was that third, you still have another chance.
Can you imagine the amount of regret bias there must be? Those who missed the peak in October and the previous one, and there was one before at the SVB situation. So I think many investors know that they should probably have some bonds, because you just need them to balance a portfolio to start with. And 5 seems to be a magic number. It's not a coincidence that 5 is holding. 5 is sufficient to cover the inflation risk and give you a decent real yield.
Have you any concern about stagflation after the latest round of data?
Well, you heard what he said. I don't see any stag, and I don't see that much inflation. So, and actually, I think the technical definition requires there to be a recession and inflation going up, and we're nowhere near that. So if there are varieties of stagflation light that might be possible, but it doesn't look anything like the stagflation of the 1970s. That's always been the fear, that you had some kind of wage price spiral with no growth. And that just really isn't happening, Vonnie. It looks very unlikely.
We will get more wage data, though. That'll be closely watched later today. What would cause this market to reprice once again, Stephen? It seems like every couple of days it's repricing now.
Well, I think we're due a period of calm. So I think bond investors are going to be happy if it gets a bit more boring, because it's supposed to be boring. It's not supposed to be drugs and rock and roll. So it's supposed to be calm like this. The kind of things that would really worry me are a policy mistake. If the Fed was to get into easing mode and then have to reverse, how do you price that into the forwards? How do you price in the up and down? And so I think a period of calm, and just if the 5 can hold for the 2 years, there's no reason why we can't get down towards 4 later this year.
You're actually anticipating 3 on the 10-year by the end of the year. Are you still looking for that?
Well, let's be a bit more modest. I reckon we'll be nearer to 3 than 5 at the end of the year, which means we just need to be below 4. And it seems to me that 3 is the right handle. Whether we can get all the way to 3% or not, maybe that's a bit aggressive. But to me, that 3% would be consistent with what the Fed says it's going to do. It says it's going to start easing, and the longer run dot is still just above 2.5. Now, some people may think that's too low, but if that's what they're saying, then the expected value for the 10-year Treasury should be nearer to 3 than 5.
As you say, we've been in a drugs and rock and roll period. Bonds haven't really been behaving as they used to. Does that revert? Do we head towards semi-retirement in our old rock and roll age?
I think we have to take a step back and realise what's caused the bond yield to go up. Now, it's tempting to think it was the latest data release, latest inflation print, but a more careful inspection would say it's more about growth surprising on the upside. Why did growth come through so strong for so long? Well, there's immigration, there's fiscal largesse, which has just continued, and there's some go-go in the stock market linked to tech stocks. Now, how sustainable are those 3? And this is without even talking about the election. It's just thinking about probabilities and scenarios. How plausible is it that all of those 3 are in place in a year's time? I'd say not very. And actually, how many people actually forecast those 3 variables? So it seems to me that the yields are high because of the real yield, and that's because of the growth, and not because of the inflation. It strikes me that we are going to see yields slide down towards a more sensible level.
Certainly didn't seem like Fed Chair Jay Powell was overly concerned, that's for sure.
Yeah.
China is another wild card here. And I know that you're interested in China. Do you see this latest sort of investor interest as being a sign perhaps that we're over the hump?
Do you know, it's a great diversification opportunity. Whether it's in equities or bonds, investors will look at any kind of product that is non-correlated or lowly correlated to start with. So, and maybe China just went too far, the sell-off in stocks. For bonds, it doesn't look like yields can go up much. And so there's something for both equity and bond investors. The thing about China that matters to me is that the rate differential is so much to the US that if you add that on to what's going on in Europe, it's another factor that goes into the Treasury story, because how far apart can these yields go? It's not sustainable. So China is exporting disinflation to everybody else, and it may have gone too far in terms of selling off at the start of this year. So a period of stability there as well, I think, is going to be quite welcome.
And then, Stephen, we've obviously had a huge amount of volatility in currencies, more than we had for a long time. So for a long time, it was kind of a head-scratcher why currencies were so calm, right? That's definitely changed.
Do you know, it's true, my colleagues were talking about how boring FX has been. And in fact, it has been not doing very much. And now we have all this action. Clearly, Japan must be drawing a line in the sand here. So we probably can't put too much focus on what's happening today because they're closed. But there could easily be some kind of intervention. But it seems to, for now, they've done the job. But the most important thing is that US rates aren't going up, because it's the rate differential and the growth differential that's the real problem for the dollar yen. So as long as the US side calms down, you can see that the Japanese authorities will have less to do.
Well, and then the problem is that it's been affecting emerging market currencies all over in recent days and weeks. Does that change any of your outlook on where might be value?
It's a very good point. It's difficult to find value in local rate markets in FX, because by the time you've done the hedge, there's nothing left. So it seems to have been much better in the EM external debt. This is dollar-denominated bonds, and you can see in this region the focus on Egypt, for example, and there's been Turkey. So emerging markets has been a better investment through the external debt. But the local rate markets are not really going to start moving in a positive direction until you can see the dollar turn and the US bond yields come down.